But let's welcome on board Ayaz Motiwala, Senior Fund Manager at Nivalis Partners. He joins us all the way from Hong Kong. Ayaz, hi, morning. Good to have you on the show. And after a long gap, how is it that you're sussing the market mood in India, Ayaz, amidst, while yes, the Nifty is an all-time high, so is the Sensex. But again, individual portfolios, they continue to bleed. And within the Nifty also, it's just those 8-10 stocks which have led us to the all-time highs.
Hi, good morning. Yeah, thank you for having me on. Yes, it's indeed been a while. It's been a pretty rocky market. I think for the last year and a half now, I'd say 18 was a complete sort of washout after a decent start in Jan-Feb last year, like this year. So, and there are numerous reasons to give, as your earlier speakers mentioned about the disappointment of earnings for a long period of time, maybe 5-7 years in India. So what the market keeps climbing up, although it opened up very broadly in 16-17 and then has narrowed down because the growth prospects of only a select few companies have been half decent, but they've at least achieved those numbers.
Sure. Ayaz, I know you really look deep for value, but before I come to that, do you see what's happening right now with regards to the continued news flow around NBFCs, over-leveraged companies, and now auditors? Do you see any of that as a crisis of confidence, or do you see it more as a cleanup and that the worst is over?
I think you touched upon it. I personally, or I mean, I'd say for everyone concerned with financial markets, I think it's a good situation to be. I wouldn't use words like excellent, etc., because obviously investors at large, whether it's part of mutual funds or corporates who put their treasury money based on confidence or credit ratings, have suffered and taking on these write-offs. Right now, in terms of accounting, and probably they may see very little of that cash coming back to them. So that's the unfortunate part. As I said, the good part happening is at multiple levels. If you were to start off with by saying the value of credit ratings. And this whole tightness in the securitization market, the whole tightness in the issuance of CPs, etc., where the true worth of the companies and that few hundred basis point differential which you see across other markets, let's say as an example the US, will keep showing up now, and there will be a good marked difference that you'd see from a B or a triple B corporate to maybe even an A corporate. And clearly triple B, enough has been written about it and has been in the past, I'd use the word doled out, will be given out much more carefully, and in a very deserving fashion only to select corporates. So I'd say it's a market clearing itself of the mess it got into, and we can go on for a long time on how the liquidity happened looking back in hindsight, but I'm sort of putting a guess that the November 2016 demonetization had a trigger, and we know that through the banks a lot of mutual funds got money in their various fixed income schemes, and that went on for a year and a half, and then through the famous sort of ILFS saga and otherwise has opened this up into the cleanup episode. So there will be still pain. I think we're seeing some new corporates now getting caught up. We've got a round of payments to be made by corporates to mutual funds who have sort of directly subscribed to such papers. So we've got something coming up right now as well. It's still a journey. I wouldn't want to call it whether it's at the end of the road or stuff like that. I mean, in fact, it's very tough to call it right now on where this period is. But suffice to say, we are on the right track, and this sort of cleanup exercise is extremely positive.
The kind of cracks that you're seeing across banks, Yes Bank, of course, that's a different case in point, but even the others, while Yes Bank is at a 52-week low, most PSBs as well are cracking quite hard in trade. But yes, while a recovery in the real sense may be a little away for consumption as a segment, autos and staples in particular. But would you say that maybe the best, or rather the worst, is already baked into the stock prices, and maybe now is the time to start nibbling into these spaces? Or would you say wait it out, wait for the yellow weeds or green shoots to emerge, and then you will have enough and plenty time before the actual recovery on ground to buy into any of these stocks?
So I would say, the answer to this question is sort of, for investors like us, it's an integrated, sort of circuitry that the market has built in, right? I mean, related to some of these banks hitting 52-week high, you obviously got the big banks, such as Kotak Mahindra Bank or HDFC Bank or, Bajaj Finance, etc., where money is still going in. And the reason is what you pointed out earlier in the program, that on a 3-5 year basis, everyone expected a lot of economic recovery at the macro level and a lot of earnings across sectors, whether it's industrials, commodities, autos and consumer included. And that has eluded the market. And so clearly the market participants are still in the search for growth. And now that this fear has come in, people are classically moving, if you were to call it, a flight to quality, whether it's quality banks, it's quality consumer companies, or the whole pack. Now, so that is that there is a narrow universe to sort of participate in, and people are pushed to that corner. So, the market gives the valuation. The consumer companies are definitely at a lower plane over the last 5 years than they were over the last sort of 15-20 years, where I think volume growths have come down, quite substantially. They're probably 2-5% volume growths for most of the categories, except some of the new growth categories. So, so you're right. I mean, companies are indeed trying. They're putting out new products. Their hope is that the consumers, take on to these new products. But ultimately, the new products will be a small proportion of their, at their overall revenues to drive, total revenue growth. So I think, I mean, we'll probably be in some sort of a, walkabout, and where companies which disappoint over 2-4 quarters, and you've called out, various names here which have lost a third of their values, including, proper FMCG companies or, consumer apparel companies, etc. And the market's not been, very kind at this stage also. So, so you've had these companies delivering 10-15% earnings growth over the last 5 years. The market earnings growth is widely known. It's definitely in the single digits, and thus with quality and flight to quality, I think people are taking comfort in these names.
Yeah, seems to be the case. Ayaz, great to have you on the show. Apologies, we couldn't try and, get that link sorted earlier. Otherwise, it could have been a nicer, longer discussion. But we'll speak again soon.